Hello traders, what's going on? In the previous lecture, I have completed about the relative strength index indicator on a price action chart. From this lecture 1, you will learn another strong momentum indicator, that is the stochastic oscillator. So in this lecture today, I will be talking to you about the basic characteristics of stochastic oscillator on a price action chart. So let's start. Stochastic oscillator is one of the important tools used for technical analysis. Dr. George Lane was developed this technique in 1950. The indicator picks one observation point in current base in the price action chart, and it also refers to all points in the defined range from where the highest and lowest point are considered for comparison. It helps to decide current momentum when compared to high and low of set in support and resistance level. Stochastic oscillator is a momentum indicator comparing a particular closing price of a security to a range of its price over a certain period of time. This is a popular technical indicator for generating overbought and oversold signals. It gives reading that move between 0 to 100 to provide an indication of security of momentum. The stochastic reading are essentially percentage expression of security trading range over a given period of time. A reading of 0 represents the lowest point of a trading range. A reading of 100 indicates the highest point of trading range. Identify overbought and oversold signals. An overbought level is indicated when the stochastic reading is above 80. Reading below 20 indicate oversold condition in the market. A sell signal is generated when the oscillator reading goes above 80 levels and then return to reading below 80. Conversely, a buy signal is indicated when the oscillator moves below 20 and then back above 20. Overbought and oversold level means that the security price is near to tops or bottom respectively of its trading range for a specific period of time. That means reading over 80, the market would be considered overbought, while under 20 would be considered oversold condition. How to use the stochastic oscillator in trading? To use the stochastic oscillator, it is first important to understand exactly what readings are showing you. The stochastic oscillator is a bound oscillator, which means it operates on a scale of 0 to 100, and this scale represents the asset's entire trading range during the 14 days. And the final percentage show where the most recent closing price sits within the range. This makes it easy to identify overbought and oversold signals, regardless of how quickly the market price changes and how the market volume fluctuates, and the stochastic oscillator will always move in the range. So not more today. Have a nice day. Goodbye.